In 1637, a single tulip bulb in the Netherlands was worth more than a luxury Amsterdam townhouse. That's not just a one-off historical anomaly. It's actually a blueprint for every financial crisis ever since, and a huge warning about the fragility of the system we entrust our money to. These organizations promise stability, growth, and the smooth running of economies. However, the reality is that banks have been at the heart of some of the most devastating economic crises in modern history. The Great Recession of 2008 has truly exposed the fragility and recklessness within the banking system, earning a lot of people's distrust, and rightly so. Take Greece, for example, a country that has endured severe economic hardships for more than a decade due to the failings of their banking system. A whole generation has grown up witnessing severe unemployment, losing their homes, and watching their families struggle with poverty. This generational trauma has fostered a deep-seated distrust and even hatred towards banks or any kind of financial institutions. Today, as debt levels are at an all-time high in the US and in many parts of the world, it's essential for us to analyze and scrutinize whether banks are truly a pillar that the modern world cannot function without, or if they're a ticking time bomb for our economies. The truth is, the evidence suggests that they may be both. So, how did the global banking system originate? From the early banks of ancient civilizations that serve as simple financial intermediaries to modern banks that create money out of thin air. We'll discuss the history of banking and break down how banks create money. How have major banking crises in history shaped the world we live in today? And most importantly, what are the potential solutions? Let's get into it and answer all of these important questions. Banking as we know it today traces its roots back to the earliest of civilizations by the Code of Hammurabi, the first known law record in existence. In ancient Mesopotamia, around 2000 BCE, the concept of banking emerged in the form of deposits and grain loans. You see, during this time, any economic activity was highly centralized around the royal houses and the priesthood. So, farmers and merchants alike deposited their livestock, crops, gold, or silver to these temples for safekeeping. By the way, it makes perfect sense to use holy temples as banks because these sacred sites were considered untouchable. People were too scared of upsetting the gods to even think about robbing them, which is quite a clever security system. But this also meant that these temples, filled to the brim with treasures, became prime targets for neighboring kingdoms to attack and plunder. These temples and royal palaces became way more than places to deposit assets though. Eventually, the temples began making loans from their own assets and charged interest on these loans. The most common type of loans during this period was a temple loaning grain to farmers, and in exchange, these farmers would pledge their future harvests as collateral. This idea of interest and collateral that is pretty common today was actually quite revolutionary at the time, as people began to understand the concept of lending with the expectation of receiving more in return, not just for the sake of lending things. For example, if you lend someone a herd of 30 cattle for 1 year, you expect to be repaid with more than 30 cattle. The herd naturally grows, and the number of animals you get back depends on how fast they reproduce within that 1 year time frame. We can also see the amount of interesting concepts that are still used in the modern banking created during the ancient era. The well-educated Babylonians of the 3rd millennium BCE learned enough algebra to solve complex problems, like calculating how much grain to use for sowing their fields. They even understood logarithms to be able to calculate compound interest. So, The history of banking extends back to the first time people felt the need for a medium of exchange and a means of securing their many forms of wealth. It was during these early times that the fundamental principles of banking, interest, and collateral began to appear or at least recorded in society. And these ancient practices are all still in use today. Now, although the ancient era saw some parts of banking that are still used right now, what really is the beginning of modern banking was born in the medieval period, particularly in Italy. You see, during this time, gold was universally accepted as a means of exchange. It is shiny and looks luxurious, so it has a good intrinsic value on its own. Gold is cost-dense, extremely durable, and has a limited supply. The fact that it could be easily minted into coins meant that gold facilitated transactions and commerce on an unprecedented scale. Gold's universal acceptance simplified trade among nations with different local currencies, as its value was recognized pretty much globally. The process was quite straightforward. Gold coins were minted with a standardized weight and purity, which meant that their value was consistent and trustworthy. People could exchange these coins for goods and services, confident in the metal's worth. But carrying large amounts of gold was still inconvenient, and also very risky out of the fear of attracting attention and getting robbed. This was where banks came in by providing a solution. To mitigate this risk, medieval merchants began to deposit their gold with trusted institutions or individuals who issued promissory notes or bills of exchange. Think of the bills as kind of a check, an early form of paper money that was created by private banks rather than the government. These bills of exchange could be used as currency, representing the value of the deposited gold without the need to physically transport the actual gold. Furthermore, it could reflect a much larger value than how many coins you can fit in your pockets. Merchants could now use these promissory bills to settle debts without the need to carry large sacks of heavy gold coins, making long-distance trade much safer and more efficient. So, banks began to provide a secure place for gold deposits and issued these promissory notes as a representation of a promise to pay a certain amount of money on demand. Note the word on demand there, as it will be important. As a reward for their services, these banks will charge a fee or interest on the deposits they stored and promissory notes that they've issued. After all, they offered secure storage and helped facilitate safer transactions and expanded trade networks. People trusted these institutions as they managed to gain a fair track record of issuing bills that actually worked during transactions and keeping their wealth safe inside a safe that was protected and fortified. The stroke of genius that these banks had was when they discovered that rarely did all depositors demand payment at the same time. This incredible insight allowed banks to create money and lend to people. By doing this, banks could generate interest from the loans they've issued, thereby massively increasing their profits. This also led us to a revolutionary concept that is still in use today: money creation through lending. You see, when a customer goes to a bank to request a loan and the bank approves it, two things are recorded. First, the customer owes the bank a certain amount of money, due to be repaid at a specific time and at a certain interest rate. Second, the bank owes the customer the same amount of money, which the customer can retrieve on demand whenever they want. This simultaneous creation of mutual obligations meant that actually, a customer borrows from a bank and a bank borrows from a customer at the same time. The debt the bank owes the customer can be used as money, allowing that customer to use their bank account to pay their mortgages, car loans, businesses, jewelry, and pretty much anything else. Economists say that banks have the power to create money because customers can use the bank's debt to buy anything they want. This might initially seem like a bad deal for the banks and a good deal for the customers. After all, the customer can always withdraw their money at any time or use it to make payments. But banks always charge interest on loans that is higher than the interest they pay on bank accounts, basically ensuring that they will always be profitable by lending to customers. This, in a nutshell, is how commercial banks make money. Now, if it's still hard to understand, don't worry because I don't get it the first time either. So, let's use a simple example from the medieval era. In the 1600s, Nico, a successful merchant from Naples, Italy, needed a loan of 100 gold coins to purchase goods for his trading business. He then visited the local goldsmith bank owned by Enzo. When Nico requested the loan, Enzo approved it, recording that Nico owed the bank 100 gold coins to be repaid with interest. At the same time, the bank owed Nico the same amount, which he could withdraw on demand. Enzo issued a promissory note to Nico, stating that the bank would pay the bearer 100 gold coins on demand. Nico used this note to purchase goods from another merchant, Maria, who trusted Enzo's bank and accepted the note, knowing that she could redeem it for 100 gold coins whenever she needed. In this example, money is created the moment the promissory note is issued. The bank's promise to pay Nico the promissory note can be used as money, allowing him to conduct business without physically carrying any gold. The creation of this note means that new money has entered circulation, even though the gold inside Enzo's safe remained the same amount. Over time, Nico earned profits and repaid the loan plus interest to Enzo's bank. This repayment returned the initial loan amount to the bank, and Enzo earned a profit from the interest charge. So, by issuing the promissory note, Enzo has effectively created money out of thin air. This ability to create something of value from pretty much nothing is what makes banking so powerful, important, yet so hard to understand for most people. Unfortunately, the concept of banks creating money through issuing loans isn't really well known, as it's not intuitive at all. So, now we know that banks do create money out of thin air. But what's the catch? Well, although this practice is massively profitable for the banks, it does carry some risks. If too many depositors demand their money at the same time, a bank could face what is called a liquidity crisis, and that eventually creates a bank run. Imagine a scenario where a lot of people came back to withdraw their gold at once. If bank lending got out of control, which is pretty much the norm throughout history, there could be promissory notes circulating in the economy, representing much more gold than the bank actually holds inside their safes. For example, if there were notes in circulation for 100 tons of gold, but the bank only held 10 tons in reserve, and even a small fraction of people, say 12%, tried to redeem their notes at the same time, the bank would quickly run out of gold. As soon as one person couldn't withdraw their gold, the news would spread rapidly. People would rush to the bank, demanding their gold which has never existed physically. Panic would set in, and chaos would ensue as more and more people rushed to the bank to withdraw their money, escalating the situation and causing a full-blown bank run. News of the bank's insolvency would spread like wildfire, and other banks would face similar panic. More often than not, several banks would collapse and people would lose their life savings.
Some succumb to apathy. Some are swept by alarm, and bank after bank across the country is hit by panic withdrawals. New lines appear on American streets, depositors swarming to snatch out what savings they have left before it's too late. Banks by the hundreds, by the thousands are forced to close. On the eve of the presidential election of 1932, the whole financial system quakes and totters.
So, this entire system relies on the fact that not everyone withdraws their money at the same time, and that is still the case today. The difference though is today, we do have several mechanisms to help combat liquidity crises and bank runs. The most important one of these mechanisms is called a central bank. You see, a central bank acts as a bank for other banks, providing an additional layer of protection in times of liquidity crises and potential bank runs. When commercial banks face sudden and overwhelming withdrawal demands, they can turn to the central bank for support. The central bank can lend money to these banks, ensuring they have enough reserves to meet depositors' demands and not fall apart. This process, known as the lender of last resort, helps stabilize the banking system by preventing individual bank failures from spiraling into a national panic. This works well in theory, but in practice, sometimes yes and sometimes no, depending on the severity of the crisis and the amount of bailout the government is willing to give. Now, one potential drawback that this creates is that after the concept of a central bank was introduced and governments began to take full control of monetary policy, it led to a more concentrated banking system on a national level. This centralization meant that banking crises might not happen as frequently, but when they do, they can be incredibly devastating. Before central banks existed, each bank handled its own sort of currency unique to that bank. Banking failures happened more often in such a fragmented system, but the impact was usually much less severe. Each bank's troubles were more isolated, and the ripple effects were limited to specific towns or communities. However, today's interconnected and centralized banking system means that a failure in one part of the system can pretty much destroy the entire system. This trade-off is important to understand. Centralization isn't necessarily bad, by the way. It does provide benefits like more efficient regulation and a unified monetary policy. But it also comes with the risk that when something goes wrong, it's really bad. And there have been some really bad banking crises throughout history. These crises have often stemmed from the very mechanisms that made banking so powerful to begin with. Let's begin with the Panic of 1873. I want to talk about this first because it is one of the first examples where a crisis in one continent could cascade into another, highlighting just how interconnected the global economy is. The Panic of 1873 began with over-speculation in railroads and real estate in the United States and Europe. You see, during this time, the expansion of the railroad network was seen as a golden opportunity for massive profits. Investors poured large amounts of money into railroad companies, believing that everyone who invested in them would be rich. It's like an old-school dot-com bubble, but with railroad companies instead of internet companies. This speculative mania also meant that banks were more than willing to lend vast sums of money to these companies, often without proper risk assessment. Meanwhile, in Germany and Austria-Hungary, the economic boom was driven by similar speculative investments in railroads and industrial expansion. Investors in these countries also poured money into projects with the hope of good returns, and banks similarly provided extensive credit without adequate risk assessment. But the bubble eventually burst when many railroad companies were not as profitable as expected. Companies started defaulting on their loans, leading to a loss of confidence among investors. In Austria, the collapse of the Vienna Stock Exchange in May 1873 triggered a wave of bank failures and economic distress. Austrian banks, who were heavily involved in speculative investments, were getting bankrupt. In the US, The final blow struck on September 18, 1873, when J. Cook and Company, one of the most prominent banks financing railroads, declared bankruptcy. With one of the biggest banks collapsing, panic spread like wildfire as investors scrambled to sell off their stocks and withdraw their deposits. Fearing the domino effect of even more bank failures, this sudden surge in withdrawals led to a classic bank run scenario. Banks, which had overextended themselves by issuing way more loans than they could cover with their reserves, found themselves unable to meet the demands of their depositors. A little bit of fun fact, the Panic of 1873 was originally dubbed the Great Depression. It held that infamous title until the 1929 Great Depression redefined the term. Compared to that, the 1873 Depression didn't seem so depressing anymore. After talking about the Panic of 1873, we need to turn our attention to perhaps the most infamous economic catastrophe in modern history, the Great Depression of 1929. This crisis not only crippled the US economy, but also led the entire world into a catastrophe. The origins of the Great Depression can be traced back to the Roaring Twenties, a period of massive economic growth and stock market mania in the US. During this time, the stock market was booming, and 10% of Americans were investing in stocks, often with borrowed money. That number might not sound like a lot, but later, nearly a third of the American population would lose their jobs and life savings during the Depression. Okay, so banks played a crucial role in this speculative frenzy, extending loan to people and businesses eager to capitalize on the stock market's seemingly endless growth. This was also the golden era of margin trading, where investors could buy stocks with a fraction of their value, borrowing the rest from their brokers, which is crazy to hear even in today's economy, let alone in the 1920s. This speculative bubble continued to inflate until October 1929, when the bubble eventually burst. On October 24, 1929, known as Black Thursday, the stock market began to fall. Panic selling ensued, and the market continued to plummet on Black Monday and Black Tuesday. By the end of that week, the stock market had lost 30% of its entire value, wiping out billions of dollars in wealth in the process. The collapse of the stock market had immediate and devastating effects on the banking sector. Banks, which had heavily invested in the stock market and extended loans to so many investors, found themselves in a precarious position. Many banks faced bankruptcy as borrowers defaulted on their loans and the value of their stock portfolio evaporated. Bank runs became a common sight as depositors rushed to withdraw their savings, fearing that their bank would collapse. Banks were unable to meet the sudden surge in withdrawal demands, and this led to a wave of bank failures across the country. As banks failed, businesses lost access to credit, leading to widespread bankruptcies and layoffs. Unemployment soared, reaching a peak of 25% in the United States. The economic downturn was not confined in the US, by the way. It quickly spread to other countries, plunging the global economy into a deep depression. International trade collapsed, and countries faced severe economic hardship. Just as in the Panic of 1873, the Great Depression showed that financial instability in one part of the world could have profound and lasting effects on the entire global economy. Now, let's move on to the 2008 financial crisis. Again, this was a catastrophic economic downturn that originated in the US, with reckless banking practices at its heart yet again. Do you see the pattern here? You see, during the early 2000s, banks in the US began issuing subprime mortgages to borrowers with poor credit histories. This practice happened because of the early 2000s housing boom, in which home prices soared due to high demand and mostly speculative investment. This housing boom created an environment where banks believed that rising property values would mitigate the risk of lending to subprime borrowers, as these properties could always be sold at higher prices in the case of default. It was obviously a reckless thing to do, driven by deregulation, the nation's pressure to increase home ownership rate, and the demand for higher yields on investments. The assumption that banks had back then was that as long as property prices do not ever fall, then they can get away with everything they've done. These high-risk loans were bundled into complex financial products like mortgage-backed securities and collateralized debt obligations, which were then sold to many unsuspecting investors. Credit rating agencies, incentivized by the very banks they rated, assigned higher ratings to these products, misleading investors about their true risks. Banks were so reckless that they've issued loans to virtually anyone who applied. Mortgages were granted to people with no income, no jobs, and no assets, the so-called ninja loans, based on the deluded belief that housing prices would continue to rise forever. This irresponsible lending inflated the housing bubble to become unsustainable. By 2007, cracks began to appear as housing prices started to fall. Borrowers defaulted on their mortgages at alarming rates. The value of mortgage-backed securities plummeted, revealing the toxic nature of these assets. Investment banks, going all in on these toxic assets, faced gigantic losses. The tipping point came in September 2008 when Lehman Brothers, once the titan of Wall Street, declared bankruptcy. This event sent shockwave through the financial system. Banks, fearing for their survival, stopped lending to each other, leading to a severe credit crunch. Companies couldn't access the credit needed for day-to-day operations, leading to massive layoffs and bankruptcies. Panic ensued as depositors rushed to withdraw their savings, leading to bank runs. Even established banks like Washington Mutual and Wachovia collapsed. The US government had to intervene, injecting billions of dollars into the financial system to prevent a total collapse. While the focus here is on the US, the crisis quickly spread worldwide. Countries like the UK, Iceland, and Greece experienced severe economic distress due to degenerate banking practices and exposure to toxic assets. Again, this global ripple effects highlights the interconnected nature of our modern banking systems, where most banks around the world experience similar highs and lows at the same time. Now, in the three major crises that we have reviewed, the Panic of 1873, the Great Depression of 1929, and the 2008 financial crisis, it is clear that the common denominator is the recklessness of banks. Overspeculation, lending money freely without proper standards, and inadequate regulations have all played significant roles in these economic catastrophes. Each crisis serves as a reminder of the potential consequences of allowing financial institutions to operate with unchecked greed, with rules that benefit these banks for their recklessness. One of the most concerning aspects of the 2008 financial crisis, besides the deranged risk-taking, was the widespread government bailouts of failing banks. Institutions deemed too big to fail received billions of dollars in taxpayer money to prevent a complete collapse of the financial system. While these bailouts were actually necessary to stabilize the economy, given the state of the banking system, they also created moral hazard. Banks, knowing that they would likely be rescued in the event of another crisis, continued to engage in risky behavior. These huge bailouts effectively sent a message that banks could gamble with impunity, and the government would be there to catch them if they fell. This pattern of behavior paints a picture of a banking system that resembles a house of cards. Banks, continually engage in risky practices, creating a never-ending cycle of desperation and potential collapse. If this goes on, well, the next financial crisis is just a matter of time. So, the system's fragility raises an important question. Is our banking system doomed to fail? The answer is not really. While the current state of the banking system is fraught with risks, it doesn't have to be this way. One of the fundamental issues behind recurring financial crises is the misalignment between financial sector and the real economy. Banks, in their pursuit of quick profits, have increasingly engaged in speculative investments, such as trading complex financial instruments and extending risky loans. This focus on short-term gains creates a disconnect from the real economy, where actually, sustainable growth and long-term investments are far more important to the economy than quick stock market growth. When a financial crisis occurs from a stock market crash, for example, what's truly damaging the economy is not the price of stocks going down, but the chain reaction that follows. Businesses cut costs, resulting in layoffs. Banks become unstable, potentially leading to failures, and people lose their savings, eroding consumer confidence, resulting in a drop in consumption, which in turn leads to more bankruptcies and more people losing their jobs. When the mechanisms of the economy grind to a halt, it creates this cycle of economic hardship, making it difficult for the economy to recover and function effectively. The true crises emerge when these financial disruptions led to widespread job losses, reduced economic activity, and a breakdown in the economic infrastructure that supports our everyday life. One of the best arguments on how to prevent a banking crisis, in my opinion, is one by Professor Richard Werner. His idea is that smaller, community-focused banks are better positioned to support the real economy and make good lending decisions that actually benefit the economy. Unlike large centralized banks, which often engage in risky speculative activities, small banks have a closer relationship with their local communities. This human touch allows them to make more informed decisions and allocate resources more efficiently. Unlike big banks with risky ventures, for Professor Werner, small banks are better suited to cater to local businesses, provide personalized service, and make lending decisions that actually benefits Main Street rather than Wall Street. The German's regional banking system serves as a great example of this theory in practice. The country possesses a vast network of small, local-oriented banks. These institutions actually prioritize serving local businesses and households, providing them with the necessary financial support to thrive. This decentralized nature of Germany's banking system has proven to be a good thing, especially when a financial crisis came. In 2008, German small banks were largely unaffected by the crisis, simply because they didn't engage in the deranged financial activities that most major banks did. They had a much more conservative business model by nature. As a result, they continued to support their local economies during the crisis, and the situation was manageable compared to the chaos seen elsewhere. While larger banks were busy with bailouts, bankruptcies, and restructuring after ruining so many people's lives, local banks were still approving loans, helping small businesses stay afloat, and keeping people's lives secure. This is Doverhill, and see you next time.